What if a $500 decision today could turn into $5,000 in the future? Welcome to the stock market, a world where patience meets profit. Foundations of the stock market, a beginner's journey. What is the stock market? Imagine a giant marketplace, not for fruits or clothes, but for pieces of companies. This is the stock market. In the U.S., two major exchanges, New York Stock Exchange, NYSE, and NASDAQ, are where investors buy and sell these pieces, known as stocks or shares. When you buy a share, you're buying a tiny slice of a company like Apple, Amazon, or Coca-Cola. If the company grows and performs well, the value of your slice increases. How the stock market works. The stock market runs on a simple principle: supply and demand. If more people want to buy a stock, demand, the price goes up. If more people want to sell, supply, the price goes down. Example: you buy 10 shares of Microsoft at $300 each. That's a $3,000 investment. If Microsoft grows and the stock rises to $360, your investment is now worth $3,600, a profit of $600. How much money should you invest? There is no one-size-fits-all answer, but here are safe guidelines. If you're a beginner, start small. $500 to $2,000 is a good range. Invest only what you can afford to lose. Focus on learning and building habits. First, general rules, U.S. perspective. Beginners, 10% to 15% of monthly income. More advanced, 20% to 30% of disposable income. Always have 3 to 6 months emergency savings before heavy investing. Investment strategy. Tip: use dollar cost averaging. Invest a fixed amount regularly, like $100 a month, regardless of the stock price. How much profit can you make? Historically, the U.S. stock market, S&P 500, gives an average return of 7%, 10% per year after inflation. Short term, 1 to 2 years. Risk is high. You may earn 5%, 20%, or even lose money. Long term, 10 to 20 years. More predictable, potential to double or triple your investment. Example: investment AVG. Annual return value in 10 years, $1,000, 8%, $2,159, $5,000, 8%, $10,696, $10,000, 8%, $21,589, using compound interest formula. Risks and rewards. Risks: market crashes, like 2008, 2020. Poor company performance. Emotional investing, selling too early or buying at high prices. How to reduce risk. Diversify your portfolio. Don't put all money in one stock. Invest in index funds like S&P 500 ETFs, VOO, SPY. Hold long term. Chapter 6. The Real Wealth Building Strategy. True stock market success is not in timing the market, but in time in the market. Legendary investor Warren Buffett says, "The stock market is a device for transferring money from the impatient to the patient. If you invest consistently and stay invested for the long run, your wealth will likely grow steadily." Conclusion: your first step, start by 1. Opening a brokerage account, e.g. Fidelity, Charles Schwab, Robinhood. Investing a small amount in a diversified ETF. Reading and learning continuously. Remember, start small. Stay consistent. Think long-term. Your journey in the stock market isn't just about profits. It's about building discipline, patience, and financial freedom.